Do you drive for your business? The IRS gives you two ways to deduct car costs, but picking wrong can cost hundreds. Let me show you the simple way to choose with confidence. This is the quick, plain English guide to standard mileage versus actual expenses. No jargon, just clear math and rules you can actually use on your next return. By the end, you will know which method saves you more, how to switch, and the one log that makes it bulletproof. You will also see real numbers, so the choice feels obvious. Think of your car like a pizza oven in your business. You can deduct it by counting every ingredient or by charging a flat fee per pizza. Both reach a fair cost for turning miles into money. The flat fee method is the standard mileage rate. You multiply business miles by the IRS cents per mile rate. It is simple, fast, and bakes in fuel, wear, and even a slice of depreciation. The ingredient method is actual expenses. You total gas, oil, repairs, insurance, registration, and depreciation or lease costs, then apply your business use percent. More work, but sometimes a bigger slice. Both aim to capture the same thing, what it really costs to run your car for business. The IRS lets you pick the method that gives the larger legal deduction. Standard mileage is simple and usually great for high-mile, fuel-efficient cars. If you drive a lot and keep your costs low, the cents per mile rate stacks up quickly. Actual expenses can win for pricey cars, short miles, or when repairs and insurance are heavy. If your vehicle is a big investment, the depreciation piece can tip the scale. If you are a sole prop, single-member LLC, or gig driver filing Schedule C, this choice is yours. The deduction shows up on the car and truck expenses line. S-Corp and partnership owners can deduct vehicle costs too, but the setup is different. You might need an accountable plan or reimbursements, so talk with your payroll or tax pro. If your car uses mixed personal and business, you can still deduct the business percent. Commuting to a regular office is not business, but trips between clients, job sites, or qualified home office are. Big fleets cannot use the standard mileage rate if 5 or more cars are used at the same time. Most freelancers and small shops never hit this, but delivery companies often do. Step 1. Track total miles and business miles for the year. Your business percent is business miles divided by total miles, and it drives the actual method and your record keeping either way. Step 2. If using standard mileage, multiply business miles by the IRS rate for that year. Then add business parking and tolls, which are on top of the rate. Here is a quick example. 12,000 business miles at the 2026 rate of 72.5 cents per mile equals $8,700. Add $220 in tolls and $180 in parking. Your total deduction is $9,100. Step 3. If using actual expenses, total all car costs for the year. Multiply that total by your business percent to get the deductible amount and keep receipts or statements. The regular method takes your actual car expenses and multiplies by your business use percentage. So if you drove 20,000 total miles and 12,000 were for business, that is 60% business use. Depreciation is the big swing item in actual. Newer, more expensive cars can drive the deduction higher, but you must track basis, method, and limits like luxury auto caps. If you finance the car, only the interest portion is deductible, not principal. But standard mileage already includes a built-in depreciation piece. That matters when you switch methods, because the IRS treats some of that rate as prior depreciation. That prior depreciation reduces your basis just like actual would, affecting future gains. Switch rule. If you start with standard in year 1, you can change to actual later. If you start with actual using accelerated depreciation or Section 179, you cannot go back to standard, and future depreciation may be limited. Leases are special. To use standard mileage on a leased car, you must use it for the entire lease term, including renewals. If you switch mid-lease, you lose standard for that car. Mistake 1. Calling commuting miles business miles. Driving from home to your regular office is personal, even if you answer calls, listen to training, or carry gear. Mistake 2. No log. If you cannot show dates, destinations, purpose, and miles, the IRS can deny the entire deduction, even when your bank shows car spending. Mistake 3. Double dipping. If you use standard mileage, you cannot also deduct gas, oil, or depreciation separately, though parking and tolls are allowed. Mistake 4. Forgetting business percent with actual. Only the business share of costs is deductible, and it is based on miles, not how often the car feels like work. Mistake 5. Not counting basis reductions. Using standard mileage reduces your car's basis each year, which matters if you later sell and face depreciation recapture. Mistake 6. Switching wrong. If you use Section 179 or bonus in year 1, standard later is off limits, and errors here are a common audit trigger. Pro tip: run both methods on paper for your first year and keep the better one. You only file the winner, but you learn your break-even point for future planning. Once you see the crossover, you can adjust driving, repairs, or timing to maximize savings. Use a home office test. If you qualify for a home office, trips from home to clients count as business, not commuting, which can unlock hundreds of additional business miles. Keep a simple log: date, start odometer, end odometer, total miles, destination, and business purpose. An app or a small notebook both work as long as it is consistent and timely. Back it up. Snapshot method. Track trips for a solid sample month each quarter, then extrapolate, as long as your pattern is consistent and you keep receipts. Update if your routes or workload change. Add-ons. With standard, you can still deduct business parking, tolls, car loan interest allocable to business, and personal property tax on the car. Those often add a quiet boost many people forget. With actual, those items are usually already inside your total, so do not double count. Real example: spend $8,000 on gas, insurance, repairs, and tires for the year. Drive 60% business. Your actual method deduction is $4,800. Tax ripple. Your car deduction lowers both income tax and self-employment tax. Bigger write-off means lower quarterly estimates, and that is real cash staying in your bank. Lower self-employment tax also lowers your quarterly vouchers, which helps smooth cash flow. Action step today. Pick one car and start a mileage log. Write down the odometer now, the purpose of your next trip, and set a repeating calendar reminder to capture each drive. Download last year's gas, insurance, and repair totals from your bank or apps. You will need them if actual wins, and they help you build a realistic budget for the year ahead. Create a one-page calculator. Cells for miles, rate, depreciation, and expenses. Run both methods before you file, and save the sheet to reuse every year. Note your business percent right on the sheet, so you remember how you calculated it. If you lease or might switch methods, write that choice down now so you do not forget the rules later. A single line in your tax folder can prevent an expensive change of method fix. Subscribe for more taxes explained. Next, watch Self-Employment Tax Explained, and then see Quarterly Estimated Taxes Explained to plan your cash and avoid surprises. Turn on the bell so you never miss a daily plain English tax tip.